Jigar Mistry is with us. He's co-founder at Buoyant Capital. Jigar, good to have you with us here. Thanks for joining in. Jigar, your framework and what you've done basically is looked at what sectors and individual segments of the market have done over the last couple of years as compared to how earnings have moved in the same time period. And what you are what your thought process is, and correct me if I'm wrong, is that except banking and financial services, everywhere else, prices have moved significantly higher relative to what earnings are growing by. So tell us more. Expand on that, Jigar.
Right, Prashant. Good afternoon. Nice to be on your show again after a while. So look, essentially, if the index has gone up, so I'm talking about the broader index, the BSE 500 has gone up, say, around 40-odd%, and earnings growth has been only about 23-odd%, then one thing is very clear that the share price/price movement has been much faster than earnings growth. Now you take a step back and you realize that whenever you do a 5-year and a 10-year rolling return analysis across indices, across different sectors, across even larger stocks, then the EPS growth and the share price growth always aligns with a percentage point here and there. And I have put out a lot of data on that account. So essentially, if in the longer term, it's always going to align. And if it is misaligned in the shorter term because PE expands or decelerates, then it's fair to assume that either the earnings need to pick up quite dramatically or the sort of share price needs to come down for them to converge. Does the earning growth look like it's going to go up? If you look at that 22-23% growth last year, the June quarter growth was somewhere in the single digits for BSE 500. For larger caps, it was around 7-odd%. Smaller caps, it was around 13-14%. So if earnings growth is clearly not going up, then it's fair to assume that longer term, either the time needs to pass quite dramatically for it to align or the prices need to come down. From that framework, first, let's discuss which are the sectors which are making a lot more sense. So clearly among the best performing sectors have been, say, real estate, which is up 74%, utilities, which is up 60%. You look at earnings growth for utilities, it's something like 40%. The same is the case with real estate. Then you come down to, say, something like consumer discretionary, up 51%. Earnings growth has been something like 30-odd%. So across a vast majority of sectors, you're seeing a framework where earnings growth is not catching up, but clearly sort of share price movements are going way higher because of the fact of the way in which the liquidity is behaving. And we can take this up if you feel like on why the liquidity is going up. And we did discuss some part of that analysis last time around.
Jigar, hi. Please expand on that, because this is going to be a concern, right? There's so much liquidity sloshing around. And as long as those earnings come in, it's probably okay. But if the earnings start tapering off, and even I got some of those inputs from a couple of fund managers saying that, somewhere this whole talk about the investment cycle picking up and, major sort of moves, it doesn't seem to be adding up. So there's some fear around Q2 earnings. Just expand on that point.
Yes, sir. So see, essentially, why are we here, right? So you look at starting October 2023, the share price growth and the fundamentals were broadly aligned. But after that, because Fed appeared to pivot sooner than expected, or the fact that BJP won those 3 state elections, put the Indian markets in a trajectory of its own. So if you remember November 23 and December 23, we were up something like 14 or 15% if memory serves right. And after that, I think that's kept on going up, even when we realized that, hey, the Fed is not going to cut rates as fast as we thought they would, or BJP is not going to win enough seats for them to change the fundamental fabric of the country, by which I mean, institute sort of farm laws, land acquisition, which will help you grow in manufacturing. But despite those 2 events not panning out, Indian markets kept on going up. And one of the reasons why that transpired very clearly is how retail has generated its wealth over the past 4 years. So I think we discussed this statistic sometime in the past, that at the bottom of COVID 2020, the retail ownership in India was something like 8 lakh crores. So if you take all the listed entities, multiply it with retail ownership, that was about 8 lakh crores. In June 2024, so in about 4 years and 3 months, That's gone up to a whopping 63 lakh crores, right? So retail, and that's not so much as a flow impact as much as it's a wealth impact. So retail as a cohort has generated a whopping 50 lakh crores in wealth. And just to put things and numbers in perspective, whatever India saves in real estate, bullion, equity markets, and bank deposits, the number last year was closer to 14 lakh crores. So 100 crore savers in India save 14 lakh crores. 10 crore active demat account holders in the past 4 years have generated 50 lakh crores in wealth. And they think the only way to keep generating more and more wealth is buying the same small cap stock, buying the same small cap mutual funds. And because of the free float sort of restriction, they keep on going up. And on paper, a lot of value and wealth is getting created. But increasingly, if you look at the sort of liquidity analysis, you're not finding enough reasons for why this would continue. One way to think about it is that, look, if the largest sort of most seminal event in a decade happened with BJP not getting absolute majority on its own, and the impact of that event was like 1.5 days at max if you are liberal, then how is the party ever going to stop? And yeah, that's a good way to think about it. But historically, we have always seen that whatever isn't sustainable has always found ways and means to collapse. So the trigger may not be known yet, but eventually I think some part of this extravaganza has to taper down to a more sensible level.
And we are running into elections again, right? State elections this time, next week, Jigar. So elections to election, we are up a clean 3,000 points on the Nifty.
Yes.
So it's just been quite incredible in that sense. So let's talk about areas that you like then, Jigar, from here on. Why don't you run us through that? Yeah.
Right. So as we discussed, Prashant, yes, banking financials across 1, 3, 5, 10 years, sort of it's a reasonably decent place where earnings growth has kept through. The indices and stocks have not performed as well, with a very clear reason that it's as much a ownership issue as much as it is a fundamentals issue. Ownership issue because if you look at FIIs and look at their top 10 ownership names, 6 of them are banks from an overweight standpoint. So whenever the interest rates in the US were on their way up, clearly you saw a scenario that FIs wanted to exit all the risky assets, which includes India. And therefore, they were continuously selling, which meant that the stocks didn't do all that well at the frontline level. Obviously, a lot of smaller banks and larger private sector banks did very well. But at the index frontline level, market cap growth-wise, they didn't keep pace. But now with the rate cuts in the offing, and although we might not go down to sort of zero interest rate, but banking financials as a sector does offer a lot of opportunity. Secondly, a lot of these sectors where earnings appear to be sort of bottoming out. So think of, say, chemicals to a certain extent, CDMO plays, pharmaceuticals. Those are the names where I think it makes a lot of sense incrementally to look at, and also sort of staples. The staples haven't done all that well last year. It was, in fact, among the second worst performing index after financials. But and rightly so to some extent because earnings haven't kept through. But I think the next round of growth can pretty much happen from sectors where the earnings is now rebounding, given the base effect, and the businesses haven't done all that well, and incrementally all the liquidity can gush through to a lot of these sectors.
Okay, all right, got it. Thanks very much, Jigar, for joining in today. Good talking to you, and we look forward to the next conversation. You have a good weekend. Moving on then, both of